Welcome back to the Scholar Wealth Podcast. In today's episode, when does it make sense to go beyond wills and set up a trust to make wealth transfer smoother for your family? Next, private REITs in the senior living community. Is this a trend or a trap that we have to watch out for? And finally, a fresh attending physician with a big bonus. Where should that money go? Plus, in our From the Field segment this week, an early look at the 2026 Personal Wealth Conference with registration now officially open. So let's get into question one.
My parents only ever had wills, and it is making things complicated now that they've passed. Now that my wife and I have accumulated a $5 million estate, we're wondering how to avoid this for our kids someday. At what point does it make sense to set up a trust instead?
When it comes to the trust conversation, in your case, it's not a number perspective. And I think that's what some people get very wrong is they look at this and say, well, I hit a number, so that means I have to have a trust. And it's not as much about hitting a number. It's when the overall complexity of the state or family dynamics or legacy goals are going to call for something a little bit more intense. They're more structured than a simple will. And the reason for that is because once you start moving into a multi-million-dollar range of this high complexity, wills are likely going to fall short or not really get the end goals that you're expecting. What I mean by that is you're going to end up going through probate process where the courts are going to be determining where money goes. That cause delays. You'll have a year before all assets are distributed, sometimes worse, depending on what types of assets are there. So the nice thing about a trust, it just streamlines that transfer. So we're saying it's not necessarily a number as much as there's, as assets start to increase, then there's more assets out there, which means you want to have a little bit more control of where all that's going. And so that way it has a much smoother time getting to your heirs, but also less time. There's some added cost savings there too. But with the trust, you're going to add a whole new level of control around distribution, protection against mismanagement, and you can add in different factors related to divorce, creditors, anything. So when you start thinking about this, now in your case with $5 million, and this is not uncommon. The amount of times I've worked with people who've come in and said, we're dealing with this with our parents now. This was an absolute disaster. We don't want our kids to have to go through this type of disaster. What can we do? In your case with $5 million in a state, that's a good amount of money. That's going to be a situation where you're going to be, how many kids you have, you're going to have likely millions of dollars going to your children all at one time with the will. The court's going to determine that. That's life-changing money. So with that type of money going out to the kids, it probably does make sense to talk to an attorney about setting up a trust so that way you have a little bit more control over, you're going to inherit this kind of money. This is what's expected. This is how the money should transfer, and help protect them as much as it is protecting you in a way of really causing your estate to be a burden on them when it should be a benefit to their family and to their financials. And now we can jump on to question two.
We've been pitched a few opportunities to invest in senior living communities through a private REIT. Between aging demographics and rising care needs, it seems like a strong trend. What kind of due diligence would you recommend before investing?
So we have to be careful in something that sounds like a sure thing. And I know that's not what you're saying, that's a sure thing, but whenever there's a really good trend, and there's no question there's a trend toward senior living communities, and of course REITs have now come into that and everything else, that they're strong, they're hard to get into. You hear regularly of people trying to get into these types of communities and they can't. There's waiting lists that are years long and the money is insane that they're making. So it's really easy to see that and say, well, I want to get in on that action. And of course, there's going to be plenty of REITs and opportunities for you to participate in that. The only problem, especially these private REITs, you're running into the issue that any other private investment has, is that it's not as regulated. So you have to be careful about what type of assumptions are being made on the investments within the REIT. And that's the first thing we want to go through is high level, what are the things you should be looking at? And then we can go into the specifics related to this. I think high level, the things you're going to be looking for is obviously manager quality, fees, portfolio fit. What I mean by that is you're going into things like, does it make sense for you to be investing in any type of private investment right now for your broader portfolio, no matter how good it is? Once you go through that, we're going to look at how much you're going to allocate. Generally, you're not looking at more than 10, 15% of a portfolio in alts. So you'd want to allocate that out. And then You don't want to go take all 10, 15% and dump that into just one senior living community. You'd want to have a variety that you get into. So you start small to buy up a portfolio of alternatives with different vintages and different exposures. So we go through portfolio fit. Manager quality is a really big one. When you're dealing with these private investments, especially on the real estate side, what is the experience of the people running this REIT? Because I'm telling you, just as much as you're seeing this as a trend, there are absolutely plenty of people who semi are in real estate or have never been in real estate saying, this is a great way for me to start a REIT for the first time because I'm going to be getting into a space where people want to give me money really easily. So if I'm out there and I've always dreamed of opening a REIT, this seems like a great idea because I could jump in and say, who's going to disagree with me that there's not a huge need for senior living facilities and communities that are out there? No one's going to argue with that. So how easy is it going to be for my pitch to you to say, well, you've seen the demographics. I've seen the demographics. Wouldn't that be great if you participated in it? Come fund some of my REIT and put $200,000 down as an investment. So that's going to be an issue with manager quality. You'll tend to see that vary a lot more. So hopefully you find somebody who has a good track record, their experience is good. You can look at how they're compensated too, right? And you want to make sure that they're compensated based on the success of the REIT, not just funding parameters. And then fees, right? Fees and expenses can be really high, especially compared to public REITs. So we want to make sure we're looking at fees, comparing them against different types of REITs, because it's not just going to be one. You could go today and go find 10, 20 different private REITs that are focused on senior living communities. Compare fees, compare management experience, and narrow that down. From there is where you got to start having to dive into the details a little bit, and it's more on the real estate side. So you want to look at their assumptions. Whenever these REITs put together a pitch deck, they're going to have all of the information. It's going to be happy people at their new condo or the new community pool or anything, laughing at each other, riding bicycles around the community, and it's all going to look great. The PowerPoint's going to look good. The numbers are all going to look good. The charts will all be going up and to the right. Everything's going to look fantastic when you pull up these documents. The problem is that there's really not a lot of oversight of whether or not the information that's in there has to be realistic. And that's when problems tend to show up with these REITs. So whenever you start seeing return expectations, if you're seeing return expectations of 25, 30, 40%, that's going to be a red flag from a due diligence perspective. We have to be concerned with the fact that how good of an investment is this? And if it's too good to be true, it probably is. You have something that 10, 15% range, that's probably realistic as an expectation. But you start breaching that 20% area, I start being very careful about what's there. Now, fortunately, a lot of times you'll see their expectations of what they think will happen in the future and how that lends itself to the value that they're putting on this whole investment. This is where it gets interesting with the breakdown of the trend that you're seeing and the actual investment. So the trend that you're seeing is a lot of people going into senior living communities. So if I invest in that, then you have this great cash flow. You have an investment that has a good occupancy rate and all. That's fine. But the issue for the REIT is they need to have liquidity. So what they're going to be looking at is they're going to want to either build these communities from scratch, or they're going to be buying older communities, pitching the idea that they're going to fix them up, raise the rents, and then in a few years, they're going to exit. Because they have to exit. They have to be able to create some sort of cash flow so that they can give you your money back and they can invest in something else. The issue is if you go throw your money, let's say you go throw a couple $100,000 at one community and they just use that to buy a senior living community and run it, you're only going to get profit off of it. So you're not as liquid. So they know they have to maintain some liquidity. So their expectation is we're going to go and collect all this money. Maybe we buy 10 senior living communities, fix them up, and increase the rents so that way the value of each of those communities gets larger, and then we'll go sell them to somebody else. And then we'll have that money that comes in that's larger, and then we'll use that to expand and buy 2 communities or 3 communities at the same time. That's how they work, and that's how they're going to keep the profit rolling and continue to expand. Or else what are they doing, right? They're just taking your money, buying a senior living community and just giving you a dividend, and they're not expanding, and they're in the business of expansion. So they're also likely going to be holding debt. So you want to watch the interest rates on that debt. Not only the interest rates now on the debt, but be very careful about what their expectations of interest rates are in the future. So For instance, they may be looking at this and saying, well, we're going to buy a community right now for $10 million and we plan to fix it up, put some new paint on the walls. We're going to increase the rents. We're going to have this new procedure that we're running now from the sales side of things, and it's going to be great. We're going to do all this. And then because we're leveraged, what we expect is to refinance the debt at a lower rate in 2 years. That's going to drop our costs down, which is going to drive our profit up. And then we're going to sell it for a multiple of that profit 5 years from now. So in theory, that sounds fine, but there's a big assumption there in that they're going to refinance the debt at a lower rate, which is going to decrease the costs, and that would drive up the profits. What happens if they don't get to refinance at a lower rate? If they can't refinance at a lower rate, are they still going to be able to pay their bills? And what multiple are they going to get at that point? How much profit is there? And if there is no profit, does that mean they're just stuck holding this community? Or worse, going into financial trouble where they stick you with a capital call, which means they're going to reach out and say, hey, we've gone through this, we weren't able to refinance, and now we need an extra $100,000 to keep your equity in the project or in the REIT, and they're going to ask for more money. So we have to be careful about those assumptions. And that's probably the biggest thing when you're talking about due diligence and what you should be looking for. You said we're looking for things like management quality, obviously. We're looking for things like fees, obviously. We know that we're going to be locked up from a liquidity perspective for a while. When they tell you you'll have the ability to get your money back in 5-6 years because that's when we're going to have our liquidity event, that's not guaranteed. There's no contract that says we're going to have a liquidity event in 5 years. That's just what they're projecting, and that's what they hope will happen. But who knows what's going to happen? And they may hold off at that point because they think they can get a higher amount later, which is all fine, right, as long as that's there. But when you get into the actual due diligence of these REITs, don't fall for just the demographics are favorable and this is going to be a hot area. That's where problems show up, because when there's a hot area out there, you not only have great investment opportunities, but you end up with very predatory investment opportunities as well, because they know money's just going after that and you're trying to find a good one. So jump into that, look at their expectations for occupancy rates. What's their liquidity plan? What are their costs? Does it make sense? I mean, look at the thing saying we're gonna put some new paint on the walls and we're gonna increase the cost of a unit from $300,000 to $500,000. Does that make sense to you? What's the expectation there? Really dig into that. And you should. You're about to probably put a couple $100,000, should have minimums on this, into an investment. You shouldn't think of it just as, well, it's a gamble, so I'm going to throw it over there. That's a bad way to think about these scenarios, right? I hear that regularly. It's like, it's only 50,000, it's only 100,000, so I'm just going to go throw it over there and see if it works out. That's a horrible way to think about money. You're just going to throw it away and you just don't want to do the work. So do the work and look at the due diligence, or bring somebody in who can do the due diligence for you to make sure that you're investing in something that actually makes sense, not only from a demographic and high level side and macro side, but also at the fund level. Do the expectations of this investment make sense? It doesn't fit for your portfolio. And now for our final question this week.
I just received a $75,000 signing bonus as a new attending physician. I've already maxed out my retirement contributions this year. Since I don't have any loans or debt, how should I think about the tax impact and the best way to put this money to work?
So bad news on the tax impact, it's going to be taxed as ordinary income. So there's no real strategy there. So you're looking probably at planning for 40 grand as opposed to 75 is my guess. But with that $40,000, we can try to do some things with it. And you've already maxed everything out, which is good. That's going to be the base layer. You're going to do that no matter what. If you haven't already, this is probably where the taxable account is going to show up in your life and stay there forever. What commonly happens, we see this happen with lots of physicians, is they start having all this income come in right after residency and fellowship, and now the expenses aren't high yet, but income is really high, so they quickly max everything out. And what they find is that them being able to max out accounts, generally you don't have fantastic investment options from a hospital or a university. You're usually stuck with your 403B, might have a 457, maybe you do a 401A or something like that. But for the most part, your contributions are kind of capped. It's going to be hard for you to contribute more than like 50 or 60 grand, which may not be enough to meet the savings goals that you should be hitting. So if that's the case, we need to have something else. That's where that taxable account is going to come in. So you're going to have a taxable investment account to flow that money through. Now you'll have some people say, well, with the lump sum, go put it into charitable stuff, open a DAF, all of that. Now is not the time. Maybe that makes me the Scrooge in this situation, but This is your bonus money coming in. You should be using this to set a really strong foundation for your finances, as opposed to worrying too much about the tax side of things. If you're focused too much on tax, you're not worried about the base level of your finances. And right now, it's liquidity. We want to make sure we have some cushion there, whether it's short-term goals, any career stuff that comes up, cash flow, and having cash is still king here. You want to make sure you have liquidity. You're going to have a lot more optionality in your finances now and later with good liquidity. If everything just goes into retirement accounts and everything's locked up, then you end up in this situation where you may have $1 million sitting there locked up in 403Bs and 401As, and you can't touch any of it, and you have no cash. You become cash poor at that time. So you could look at stuff like starting a backdoor Roth. It'll make a little dent in that 40 if we're kind of working backwards from your 40. You've got your 40, go the backdoor Roth route. That'll take away 7 or so. So now we've got 33 left to allocate. I know it's boring. The emergency fund setup is going to be there. We don't have to call it an emergency fund if we don't want to. We can call it just a brokerage investment. And you should put some money over there. You keep it in the money market fund. That would work. If you have kids, good opportunity. You could seed fund some 529 accounts if you want to, with a few $1,000s for each of those. But I think the big answer to your question is not to get fancy with this right now. It's a signing bonus. You're just starting off. Keep some of that for liquidity. There's not a lot you're going to do on the tax side. Make sure you have the account set up. You've already maxed everything. Focus on cash. Right? Build you up a nice $20,000, $30,000 account right now and treat it as sunk costs. Right? It's going to go there. It'll be in cash. The nice thing about an emergency fund, though, is you only have to fund it once. Right? You don't have to keep funding an emergency fund every year. Next time you get a big bonus, it's not like you're going to have to refund your emergency fund again. So you're going to have that already done, and then you're going to push it over to the brokerage account. Now, I'll warn you, though, the thing you'll probably run into is brokerage accounts can be tricky in the sense that because they are a source of liquidity, it's really easy to bring a taxable account up and then bring it right back down for things like a new car or down payment on a house or anything else that's going to come up in your life here in the beginning. That is normal. You want to be careful in the sense that if your plan that you're creating for yourself says, I need to max out my retirement accounts and I need to go save $50,000 in a brokerage account, you need to make sure that that money is going to a brokerage account and it's not being taken out next year for a car or taken out the year after for a down payment or something like that. So if you have to, you may end up opening up 2 different brokerage accounts so that you have one that's structured for long-term goals, the boring stuff, and one that is, I had a bonus come in. I don't know what I'm going to do with the money right now, but I'm going to go throw it over in this bucket and we'll see what happens at the end of the year. If we haven't spent it, then I'll move it over to the boring account. That makes it a lot easier to manage those different accounts for different goals. Now, it goes against all rules of mental accounting and behavioral finance because money is fungible, but it does make tracking a little bit easier and takes away some of the guilt too, which you'll likely have in the next few years based on this of saying, I've saved all this money in my brokerage account, but now we want to go take a trip or you want to go buy something for family and you don't know if you can because you've earmarked that money already mentally for retirement. That's the way I'd handle it. Focus on the cash. Don't get fancy with it. Don't worry too much about the tax side right now. It's all going to be taxed as ordinary income. And the physician life is a life of a lot of tax on W-2 income unless you go the business route, which we can always talk about at a different time. So with that, we can go into our special segment. For today's rotating segment, from the field, we're highlighting the Scholar Personal Wealth Conference since applications are now open for April of 2026. So 2025 for our conference, we were down in Charleston. It was fantastic. We had advisors, professors, we had attorneys, CPAs, everyone talking about things like private equity. We talked about inflation. We went into crypto, obviously some estate planning conversations, market concentration, all really good stuff. My favorite part about the conference, it's a no pitch, no sales environment. You're not being pitched the latest and greatest REIT up there or what private equity fund you should jump into. Nobody up there is pitching anything. It's purely with an education focus. But the feedback we hear again and again, past conferences, especially this year, was how much value the attendees found, both in not only the session, as much as I would love to say, it's the sessions that draws everyone there. The sessions are fantastic. The speakers are great, but it's the connection they make with other people in the room. It's very rare that you get the opportunity to sit in a room without that barrier of not knowing if it's okay to talk about finance at dinner or anything like that. Everyone's talking about finance for multiple days. So 2026 is going to be fantastic. This year, we're going to be at the Grove Park Inn in Asheville. So alongside the normal personal finance conversations, we're looking for a really, truly distinct experience. So we're looking at some bike trips, some golf, some wine tasting. We'll explore the gardens at the Biltmore. Should be a lot of fun, great opportunities for, of course, some finance conversation, but meeting some other people, some good conversations there. The format will be the same as we've done in the past. So we'll have expert-led sessions. We're going to have roundtable conversations, and also, of course, that time to meet with others and talk about some of the stuff you're going through and navigating similar challenges with people who are likely in a similar situation that you're in. This year, we plan to dig into some advanced tax planning situations, legacy and gifting, always dealing with portfolio construction with a challenging interest rate environment. Lots of good stuff there. And we're always throwing some stuff right at the end that's the latest and greatest conversation that hits the news. But what I think is something beyond the structure of the conference that works really well and what makes it truly unique is that it's designed exclusively for high net worth families. So we don't have the product pitches. No one's trying to sell you any insurance or funds. It really is a space to explore those questions that you've had that you probably don't have somebody around to talk through, or the people who you may be able to ask may have some conflicts there. Questions of matter of wealth starts to become a little bit more complex, and there's a little more than just how much should I put in my 401k or should I pay off the credit card debt type of scenarios. This is a very different type of personal wealth conference. Now, applications are open, so attendance is by application, so we can ensure that the environment remains focused and valuable for everybody. So if you'd like to learn more about it, how to apply, you can check out the link in the episode description. And for this week, that's our show. Thanks for listening, and we'll see you next week. Hey, this is Stephan. Thanks for tuning in to the Scholar Wealth Podcast. If you have a question you'd like us to tackle in a future episode, share with us at scholaradvising.com/podcast. We'd love to hear from you. Until next time.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.